Okay, peeps, welcome back. So today I'm going to be discussing with you guys how to protect your capital in TSLY or any other yield max funds and still be profitable and avoid NAV erosion. Let's get it. So the first thing that I want to address is whether there's actually NAV erosion in any of these yield max funds or not. So let's take a look at some of the yield max funds that are already paying dividends so we can kind of see what it looks like. As you guys can see here on the chart, I have TSLY. So it did come down here, but that was because we were just, well, let me actually go back here for a minute. Yeah, we were just coming out of the bear market from last year, so it's understandable why it tanked. As you guys can see, there's not really NAV erosion going on here. There is basically consolidation. It's been kind of consolidating back and forth. We take a look at the actual TSLY chart here. You can see that something very similar is actually happening. Even though the price action looks like it's moving down and more up, it is still somewhat consolidating because we have this resistance area up here that it has not broken out of. And we have this support area down here that it also has not broken out of. So let's take a look at another example. We'll take a look at, we'll say Aptly. So has Aptly had any NAV erosion? In all honesty, probably not really. It looks like we had like maybe a little tiny dip below here, really small dip below the support level. You get like about 2%. And as you can see, it's pretty much just consolidating sideways, exactly like TSLY. Let's go ahead and pull up the Apple chart on this one. As soon as I can find it, give me a sec. Okay, so here's the Apple chart. So from the look of it, we got basically April 23 to roughly about April 23. I mean, Apple did move up a little bit, but it's also retraced. Apple retested roughly about the same level that it was at in April. So if we draw a line across here, see from April to pretty much where the price is now, you can see that Apple more or less is actually kind of chopping sideways, very similar to how Aptly is. I would say Apple's price appreciation potential is much greater than TSLY. Reason being is because you can see on the price chart of Apple, it's pretty much just an asymmetrical bet. It usually only ever goes up. Maybe every 6 months or so, you'll have a dip on this thing. So let's take a look at one more example. We'll take a look at OARC. So OARC has been around for a long time. I think it's actually been around longer than TSLY. As you guys can see here, we kind of have like what looks like a slight downwards channel going on, or something like a channel. It's not exactly perfect, but we'll just go with it. We'll say that that's our channel right there. And we'll pull up the chart of AARK, which is the underlying fund. There it is. All right, so as you guys can see, we'll take, December of 2022, which is basically like right about here. I gotta draw some lines here. So you guys can see that we basically more or less have pretty much chopped sideways on this thing. If you look at the price action here, it kind of bottomed out here, and it sort of has been bobbing around, slowly moving up, as you can see, whereas OARK has slowly been moving down. But you guys have to understand about basically the underlying stock of OARC is that this thing has been consolidating pretty much sideways since almost April of 2022. And the reason why that is because AARK is comprised of a lot of stocks that are in the Russell 2000. Russell 2000 is basically like small and micro cap stocks. When the Fed's hiking rates it makes it more expensive for businesses to borrow, as I've said before. So a lot of these companies that are in this fund right here are probably struggling to be profitable because of the fact that the Fed's tightening. It's expensive for these smaller businesses that are not well established, monetarily speaking, to get the funding that they need in order to become profitable over time. And since OARK only captures about half the upside that AARK would, and most of the downside, until OARK breaks out and has a huge move up, this thing probably will continue to chop around sideways a little bit. I would say maybe there's a little bit of NAV erosion here, but not a whole lot. Again, once OARK breaks out, should expect to see some pretty large movement up in the price of AAR or OARK. So now let's get into the 5 solutions you guys can use to offset some of this potential NAV erosion that everybody keeps talking about. I'm actually going to move over to, as soon as I can find it here, give me a second, over to the Tesla chart. Oops, wrong one. Hold on, guys. So you got Tesla, and we're going to pull up TSLY on the chart on the left. So TSLY. Now, if we take a look at these recent pops, you got August 23 here, August 23 here. So we'll measure the move, bottom to the top. On TSLY, you got about 12%, but bottom from the top to roughly about the same point on Tesla, you have 20%, so you got a little bit more upside. So basically what you could do is you could put, like let's say you have $1,000 to put in TSLY. You put 1,000 in TSLY for the dividends and the passive income and the reinvestment. And you could also offset the downside in TSLY by buying 1,000 shares of Tesla, the underlying stock. Because as you can see, if this thing is chopping sideways here and it's kind of ranging, you would have a lot more upside on Tesla than you would on TSLY. So basically, you would own like $1,000 worth of each or $500 worth of each, whatever you can afford, to offset some of that NAV erosion and also increase your potential capital gains on the stock. And then you take profit on Tesla. You can reinvest the shares into TSLY or do whatever you want with that. And this can be used with basically any of the yieldmax funds. So that's the first thing. The second thing would be taking profit on the way up. So you buy in here support, you take profit at the top. You just made about a 35% gain, assuming you bought in all in here, which I personally don't do. I just DCA down and let the market give me whatever profit it's going to give me. So you take profit on the way up, and then you basically just DCA back into your position on the way down. That would be the second solution. And again, you can do this with any of the yieldmax funds. So let's get into the third option here. Third option would be to take some of the dividends that you receive from your yieldmax funds and put them into dividend growth stocks, or just keep the dividends in yieldmax funds, reinvest, and put some additional capital you have on the side into dividend growth stocks. Let's take a look at some of these stocks that I know for a fact have really had some massive appreciation. So we'll take a look at Pepsi. That'll be the first one. So PEP would be the ticker symbol. If we take a look on the weekly chart, let's say that you bought Pepsi roughly around the same time that you bought TSLY. So if you bought Pepsi right here, you would have made potentially as much as a 17% gain. And well, I mean, at the same time, if you had bought TSLY, you also would have made a 38% gain. So even if you didn't sell your shares in TSLY, you could potentially use something like a dividend growth stock like Pepsi to offset some of that potential. As you guys can see here on the chart, this thing pretty much has only ever just gone up. That would be a good way to offset or hedge against NAV erosion in some of these yield max funds. I'll give you guys one more example because I don't want to make this video too long. Look at Home Depot. Home Depot is another really great one. As you guys can see, this thing is just ripping to the upside like crazy. Everybody wants to buy stuff to fix their homes, right? It's pretty normal with real estate. So if we take roughly about the same time frame, you would have got into TSLY right around this time frame. let's say you bought Home Depot a little bit before. In roughly about 10 months, you would have had a 26% upside. If you had bought back here, you would have gotten ridiculous upside. You would have got about 130%. So you could collect dividends in these, collect dividends in these dividend growth stocks, and still have upside to offset potential NAV erosion in the yieldmax funds. Now let's take a look at the dividends for both Pepsi and Home Depot, just so you know that you're getting paid. So Pepsi, as you guys can see, this thing pretty much only ever raises its dividend payout year over year, literally. So you would get, not only would you get a dividend and you get massive upside appreciation, but you would also get a dividend increase basically every single year from this company. And if we go over to Home Depot, which is ticker symbol HD, you would also pretty much only ever get a raise every single year. It actually looks like Home Depot's raises are much more aggressive than Pepsi. And Home Depot has been increasing their dividends for a very, very long time, basically since 2002, as you can see here. So you would get paid dividends from your dividend growth stocks, dividends from your yield max funds, and you would get upside appreciation potential on the dividend growth stocks if your yield max funds are down in a drawdown. So take a look at this website. You can see that if we can find it, I'm trying to see it here, but I don't see Home Depot. Well, here's Pepsi. So Pepsi, it's been growing its dividend for 51 years, as you can see. So the dividend is more or less safe. I'm not really seeing Home Depot here, but that's okay. Because if you ask any dividend growth investor, Home Depot is a very safe dividend paying stock. Now let's get into the fourth option. So the fourth option would be to swing trade. And I've mentioned this to you guys before because I do actually swing trade, but I want to reiterate just how much you can make in gains here. So I'm going to pick one of the trades that I recently took that I'm actually still in currently. If you do technical analysis, you know what to look for. You know how to identify support and resistance. You can make a lot of money on these. So I'll give you guys just a couple examples here. So let's say you wanted to get in after this golden cross when you see this green candle close above. And you basically want to hold until you see basically like a support area being built up here. You could have made 65% in roughly about a month. 65% on $1,000, guys, is $650. So what you could do is you could take out your profit from that trade, put your principal back into a new trade to produce more profit, and then take that $650 and put that into dividend paying stocks to help offset some of that possible erosion that might be taking place. If we take another popular AI stock, for example, you can take a look at this. You see APLD is another really well-known AI stock. We get in on the golden cross here. You can see this little bump up here, green candle close. Initially, you would have made as much as 62%, but if you had held, like really held for quite some time, about a month or so, month and a half, you could have made as much as 330% gains. So this would have been roughly about a 4x on your money. If you had $1,000 in there, you would have pocketed about $3,000 in profit, which you could then use to buy dividend growth stocks to offset the NAV erosion or invest more money in TSLY and yieldmax. Now, the fifth option that you guys could do, which I have not mentioned previously, is you could simply diversify your money throughout all the yieldmax funds. So if you wanted to, you could just pick a random number of shares you want to own. Let's say you want to own 20 shares of each. You'd put 20 shares of each in these, 20 in Coney, Aptly, OARC, AMZ, FB, GUI, MSFO, DSO, NVIDIA, and so on, or whatever your preferred share count is. The reason being is because if we take a look at the underlying stocks, you'll see what I mean here in terms of price action. So we'll just pick a few. So you can see Microsoft is more or less up, right? Netflix is more or less up. But then you get something like NVIDIA, you can see this thing's just ripping to the upside. It doesn't really have any pullbacks, so you can see at a bird's eye view that the price action is much different on this. Tesla's kind of bobbing around here, testing support, trying to come back up. So again, you can see the price action is much different. ARKK is also, well, I guess this would probably be better stated on the weekly. So ARKK is pretty much just bobbing around. Tesla's kind of consolidating too. NVIDIA is basically a moonshot. Netflix is kind of going all over the place. Microsoft is more or less straight up. Looks like maybe a potential double top there. And Apple is pretty much straight up, retesting support here and maybe moving higher. So these are the 5 solutions you guys can do to offset any worries that you may have about NAV erosion. Hope you guys enjoyed this video. Hope it was helpful in some way. Please like, comment, and subscribe, and I'll see y'all later. Peace.